Good morning, ladies and gentlemen. Sometimes it pays to step back a little bit and try to ascertain where the next real money flows could be coming from in the weeks and months ahead. This is a weekly chart, very long term, going back to before 2007 of TLT, and basically we are looking at where the bond market, which is the determinant of the discount that will be applied to equities, trades in various phases of the cycle. I have put here various levels which are swing levels and extremely important levels for TLT, where the market trades in certain bands according to the phases of the business cycle and the fears and the liquidity which is flowing into long-term bonds. You can see that basically when things are normal, before 2007, we were trading in a range of below par to just par. Basically a 15 point, and we can go backwards as long as you like. TLT was basically when things were normal, trading in a 15-point range from between 85 and 100, and it stayed there for many years, and that was the discounting factor applied to equities. When the crisis kicked in, things went berserk on the upside, but the bond market then returned, thinking that things would rapidly return to normal, to its usual range. That changed basically in 11 when the Fed really put in, stepped on the accelerator, and things rapidly changed. And since then, basically, apart from a couple of episodes in 14 and then in 15 and early in 16, we have been in a range, in an effective range, between 115 and 127. What people who have only been around for a few years don't realize is how odd this range between 115 and 127 actually is. It's a range that we have never really been in since I have known of bonds. Since I have known of bonds, we have been trading at par or lower. In fact, certainly lower than par in TLT. What does that tell us? Well, that tells us that when we get a break of the 115 area, we are likely to go and revisit 101 at some stage quite quickly. In a matter of a few months, we are going to have probably a 15% devaluation of the value of TLT. You can see how well the market actually respects those ranges and how many weeks it holds those ranges before it decides to do something else. At the moment, we are still in the range of 115 to 127, but if the economy really is to accelerate and inflation is to return to the 2% target range of the Fed, it would not be surprising in the slightest to see a break of the 115 level and a fall down towards 101. If we go to a weekly yield chart of the 30-year, we can see that it's flirting with the highest levels we have had for a very long time. 322 is the line in the sand that Gundlach has, and we exceeded it last week, but we closed back below it for a weekly close. This kind of behavior to me suggests that at some stage we will break it. So if we go with the presumption that at some stage we will have significantly higher bond yields, it is certain that Europe will follow them with a lag, and it is also certain that those significant money flows are going to be of a fundamental nature. If you are discounting equities at 3 or 4 plus, it makes a hell of a difference. And what it does, it tells you that equities are going to trade on a different discounting factor, and the only thing that's going to make equities trade at a higher valuation than they are now is if you get quite rapid growth. This is a very long-term chart of SPY TLT, and you can see that since the crisis it's been one-way traffic up. SPY is outperforming TLT almost almost the whole time, and we are now about to break the all-time highs of SPY TLT. That suggests that people are continuing to bet that equities will outperform TLT. Tend to agree with them. It is quite obvious now that at some stage we are going to get a flight out of fixed income instruments, because the yield that they are offering is probably not good enough to shield you from inflation, and that it is not good enough for a period of higher growth as we are witnessing at the moment. So the question is, where is the fundamental money going to go? The big money flows are fundamental. If they flee TLT, what are they going to go into? Are they going to go into equities? Are they going to go into commodities? Are they going to go into gold? What are they going to go into? Well, it's quite obvious that the preponderance of that money will actually go into equities, simply because it's such a large market. But a good part will also go towards commodities. And this is the SPY against the DBC. You can see how DBC, even with the rise in SPY, has certainly kept pace with it, and in fact outpaced it. So that tells us that money is moving and will continue to move into DBC as well as SPY. It is quite obvious that people are betting that there will be continued inflation and continued high growth, and that is likely to prop up both equities and commodities, and gold to a certain extent, probably far less. But certainly bonds are our least favored sector, while commodities, investment allocation sector, while commodities and equities have to be favored, as they are the ones that are likely to shield money from devaluation and also to give the best long-term return. If we continue and apply the methodology of Gundlach, who is doubtlessly a very intelligent chap, we see that this is gold over copper. We see that we are now back into the range of the top of the range in 12 we had in 12, 13 and 14. So this ratio is saying that the economy is not ready, has not yet plunged back into the lows of 12, 13 and 14, but it is at the top of the 12 to 14 range. If we now have a look at what that means for TLT, and we have a look at the weekly chart of TLT, this is 12, 13 and 14. So it is saying that we could easily drop into the below 115 towards the 101 area. That is what the ratios are saying, and it's certainly not something that we want to fight. The market starts dropping below 115, you will see a rapid deceleration in TLT, and you will see money being allocated away from bonds, and these are trillions of dollars being allocated from bonds into equities and into commodities. How does what we have said so far help us with our long-term trend plans for equities? Well, what it suggests is that at some stage there will be renewed upward pressure on equities, simply because fundamental money will be shifting in the trillions of dollars away from fixed income to growth, and that is commodities and equities. On the equity side, that should mean that we will definitely at some stage retest these highs, simply because the market will be in a liquidity push higher, and then the market will reassess itself and probably do a repeat of January at some stage, when it realizes how far bond prices have gone and how it has to basically discount the whole market at a completely different valuation, not anymore at 3% but at 4%. But the first move will definitely be higher. So as you can see, and if we enlarge it, this is very much here. We've come to the conclusion that it's all been very, very corrective behavior. There is no push down. The moving averages seem to catch the market extremely well, and it would be surprising to us if over the course of the next couple of months we did not go and test at least 2,850, which is the upper weekly Bollinger Band, which is very flat. But we think we definitely will get that move rather than a move through these levels here, which is 2670. The market seems to have made up its mind that it wants to stay above the 2670 pivot, and that to us is indicative of a market which will accelerate higher, because there will be buyers of equities on a shift out of bonds. Now, I apologize for the long preamble, which is actually being used by me to say the following. One of the greatest macro moves that we are likely to see in the months and years ahead is actually a shift out of European bonds into European equities. European money managers have trillions and trillions in liquidity being stashed away in bonds, and they have to at some stage move out of those bonds and into equities. Will they buy US equities? Of course they will, but will they keep the bulk of the money in the home markets? Yes, they always do. That is what money managers do. They keep the bulk of the money home. We are now likely to see, over the course of the next few years, significantly higher prices in European equities, simply because of that huge shift which is going to happen at some stage. We are quite sure the next big trade at some stage is European equities against European fixed income. Some will say, well, European fixed income has done absolutely nothing for years. This is a weekly chart of the Bund. It had a very good week. It had a very good week on the back of Italy, because what's happened is everybody has flown, out of Italy and into the safety of Germany, basically saying, I don't care if it yields zero, if it yields negative, I want to have the safety of Germany, just because Italy is falling apart and its bond could go to all sorts of ridiculous levels. That is true, but that is a very temporary phenomenon. That's a phenomenon which lasts 2, 3, 4, 6, 8 weeks. It is completely unimportant in the greater scheme of things. Can the Bund fall towards 40 and these Bollinger Bands? Absolutely it can. But so what? It is not something that is very important to us in the greater scheme of things. Can the yield fall down towards 26? Yes, probably. but these are going to be wonderful, wonderful opportunities to pick up long-term positions against European equities, i.e. long European equities, short European bonds. This is the Italian bond, and you can see what it's done. It's gone in a week. It's done basically 2 months worth of work and gone up to the top of the weekly Bollinger Band. If the ECB wants to stop it, it's going to stop it here and now, i.e. Monday or Tuesday. Maybe the market goes a little bit through the Bollinger Bands and then the ECB steps in and smacks it back down. If it does so, normality will return to the market and people will basically just trade it in a sideways fashion. But you can see what is likely to happen in a very brief period of time when the fundamentals at the moment are saying that European fixed income are in a complete bubble. They might be a year or two behind the US, but you saw what happened to TLT. It went from the 130s towards 115, a move of 10% very, very quickly. Well, here a move of 10% would probably take it back up towards the 3% range. So we are talking about massive moves which will take place in European fixed income when the move starts. Naturally, we have to keep this in the back of our minds. This is the big trade over the course of the next 2 or 3 years, and we mustn't lose our perspective by moves which are very short term, like this move in Italy or the move in bunds over the past week. To sum up, in the very long term, this is the picture we are more likely to see than not. European yields on an average of 2.5% at the very least. EU equities probably at least 30% higher than they are now. US equities squeezed with EU equities by fundamental money flows out of TLT and into European and US equities by European managers, squeezed or at least to 3,000 before there is a significant retracement as a result of the revaluation of TLT. And TLT back to par, i.e. 100. This is what we think fundamentally is going to happen over the course of the next 2+ years, and this is the flow of the money. Of course, the best risk return is here. The shorting of the yields is going to be the most profitable trade that you can do over the course of the next few years. It'll have a lot of false starts, but we know that the EU is probably 2 or 3 years behind the States, and the States is showing us the way. As soon as Draghi is out of the way, we will probably have the first leg of this move, and this is what you need to prepare yourselves for now. You always want to prepare your portfolio for what is going to happen rather than react. So now is the time to start moving all your assets out of fixed income in the EU and into European equities, and this is the net result of this shift at some stage is TLT back to par and US equities squeezed by fundamental money flows. It is quite obvious that US equities at the moment are well supported. The valuations are not ridiculous anymore. You can definitely afford to be long of equities and enjoy the ride. Having looked at the very long term, even in the short term, equities do not look at bad risk-reward levels. The market has corrected over the past week exactly as we suggested, the overbought conditions of the previous week. The pullback has been very, very shallow, and volatility continues to behave in a very, very subdued manner. This to us suggests that at some stage maybe there will be a false break to the downside just to clear people out, but we are definitely going to test this 2750 level over the course of the next 1 or 2 weeks. 2750 is an important level, followed by 2800. We don't think we're yet ready to break 2800, but would we be surprised by a move to 2750 followed by 2800? Absolutely not. Uh, that is the direction of travel over the course of the next couple of weeks. We certainly prefer to be dip buyers of equities rather than rip sellers at the moment, simply because we see very little alternative at the moment to equities. Apart from commodities, nothing is performing anywhere near as well as the S&P. And we definitely want to avoid bonds. It is not something that we wish to invest in, and therefore we have to be bullish, or at least dip buyers in equities and in commodities. Thank you very much indeed, and tweet you on Monday.